Hello everyone, Business Guru back with what's probably the single most important topic that I'll probably cover in any of my videos. And it's the single biggest source of frustration for business owners, I think, that are trying to grow their business. And it's the most misunderstood amongst the general population. And it will prove, and that misunderstanding can be very isolating to you as a business owner. So the concept is cash flow. Now, cash flow simply refers to the flow, the cycle of funds flow from the customer making the purchase of your product to the money hitting your bank account and your ability to pay expenses and bills and obligations as they come due. If capital is the cells of a business and the building blocks of a business, then your cash flow system is the circulatory system that carries the nutrients or the blood, i.e. the cash, to the various components of your business. And like the human body, if the circulatory system isn't functioning properly, or it has a lot of constriction within it and obstruction, then the various parts of the business, or like parts of the body, will die without adequate nutrients or adequate resources in this case. So what is a cash flow? What is your cash flow system? Well, it's your series of policies and procedures that you have in place to govern your cash flow. So it could be something like as simple as your sales terms to your customer. So do you require immediate repayment or payment when you sell your goods to the customer? Do you extend credits of 30 days or a week or what have you in terms of payment? How do you deal with late payments? And how you've arranged your payment terms with your suppliers, and what your repayment requirements are with respect to your various debts and equity obligations to your shareholders, and so on and so forth. Now, how you have a lot of discretion over how you arrange and build your cash flow system. And there's other aspects to it that you don't have any control over. For instance, if you're borrowing money from a bank, you don't have any control or discretion over when you have to make your payments. The bank just dictates when they have to have their money. And so you will have fixed points at which your business must have cash outflows. And so then your entire task becomes making sure that you have enough cash coming in to meet those fixed obligations. Then you're going to have other obligations that you have some discretion over. For instance, in my business, I have consigners who send stamps for me to sell. And the arrangement that I have with my consigners typically is that I don't make any guarantees as to when I will pay them. I tell them I'll pay them as quickly as I can, but I don't make any guarantees because the stamps are typically lower value. It takes a lot of overhead to process them and a lot of time, and it's really, my ability to pay them out is really dependent on me having enough free cash flow to do so. So that's an example of an outflow I have discretion over. I can basically pay it when my cash flow permits. So that's a very favorable thing to have in your business if you can arrange as many of your obligations that way as possible. Although you're going to find when you're dealing with suppliers that you cannot just do that and have a good supplier relationship. Typically, a supplier of commercial merchandise is going to give you terms like net 30 days. And in some cases, if you've got a really good buying relationship and you buy a lot from a supplier at once, you might get 60 or 90 days. Or you'll get a partial deferral where they'll give you the 90 days or the 60 days, but they want to see you making payments regularly during that time. Or they might sell to you and require a deposit on the order, and then they'll give you the 60 days on the balance. So there's all different types of requirements that a supplier may put on you, and that will shape your cash flow system. Now, it's important to understand that a poor cash flow system is going to be a struggle to your business no matter how much you sell. You cannot sell your way out, typically, of a poor cash flow system. So, and by a poor cash flow system, I mean one where your business struggles to generate enough cash flow in order and to make the payments that it has to make on time to everybody it has to make them to. Once you get into a cycle like that, especially if there are recurring obligations and you have a lot of debt, it's really, really, really difficult to get out of it. That's what I've been facing now, and I'll get into this later in the video, but that is what I am now about to change permanently in my business going forward. And I'm doing it with a second mortgage on my house. And I'm only able to do it because I have access to the equity in the house. But if I didn't have that, I would be struggling and I would have to continue running the business with a poor cash flow system. Now, a business can often run and survive for many, many years with a poor cash flow system if it is able to access recurrent revolving funding for that business. In other words, if you have debt and you pay it off and you're able to go back and reborrow it again, you can survive and operate long into the future with a poor cash flow system that has you chomping at the bit, waiting for the next invoice to be paid, so that you have enough money to make payroll or your government remittances or your supplier payments or whatever it is that you've promised other parties. You can do that. It's just extremely stressful, I find. And one of the problems with a poor cash flow system, particularly around the discretionary obligations you have, like I do to my consigners, is that you'll find yourself making promises to pay people and not being able to meet them exactly, and having to go back and explain to them that you don't have as much money as you were hoping for, and so on. And that's not really something that you want to deal with, in the long term. And that brings me to the next point that I want to make about how misunderstood it is in the general populace. So most people, banks especially, a lot of other businesses, a lot of lay people, they will equate cash flow with profitability. So if your cash flow is poor, if you're always short of cash, they will assume that you're unprofitable, and they will treat you accordingly, which is not very well. It's a really, really harsh world out there if you're a business owner who's struggling to pay your bills. People will be absolutely ruthless in basically telling you that your business concept is unviable and that you're not a real business, you're not a success, and so on and so forth. And it can be really, really discouraging. They will often assume if you have poor cash flow that your business finances are a shambles, even though they may not be. They may be perfectly sound, but to them, because you can't pay them when you promise to, or you can't pay them on time, or you're struggling, it to them it just looks like you're unprofitable and you're not on top of your operation. And it's a big misunderstanding, and it stems from the fact that they don't teach in school the difference between these two things. They don't impress upon people that you can have a perfectly profitable business that has a poor cash flow system. You can have, I was going to say, I'm trying to make a contrast here, but of course, if your business is unprofitable, it will have poor cash flows eventually, if not immediately. So, I mean, it's a bit of a paradox, but a company that can continue to borrow and borrow and borrow and borrow and raise money is going to have positive cash flows, because all of those cash flows are coming from financing that they're raising. That's what we're seeing now with AI companies like OpenAI. They don't make any money, and they haven't made any money for years. But they're just continually raising money and burning through it. And their cash flows are positive, but they are unprofitable. And, eventually they're going to reach a point where if they don't start making, the capital raising is going to dry up. People are going to stop advancing money to it. And that's where the rubber's going to hit the road. And they're going to have to make money. They're going to have to start paying people back and paying out returns. And if they can't do that, their cash flows will be negative, strongly negative, very, very, very quickly. And they will eventually go out of business if they can't make enough profit to pay people. But initially, a business can be unprofitable and have positive cash flow. That's not at all uncommon. Now, in accounting, one of the ways that we distinguish between sustainable cash flows and cash flows that are just one-offs that are caused by either raising money or selling off assets, are that we separate, in accounting, we prepare what's called a cash flow statement, and we split it into three sections. The first section is called the operating section of the statement, and that calculates the cash flows from the normal selling operation or earning operation of the business. And so that bottom line is the cash flow that the business operations in the normal course generate. And that's the most important figure on a cash flow statement when you are trying to assess whether or not a business is sustainable. If the number is positive, then the business has positive cash flows from its operations and is a sustainable business, in that it will be able to continue operating into the foreseeable future as long as it stays profitable. If the number is negative, then it means that the business, despite its profitability, if it happens to be a profitable business, is hemorrhaging money. And it will only be able to continue operating as long as it's able to access additional sources of capital to finance the shortfall in cash flows that are occurring from operations. So it's not a good thing if cash flows from operations are negative for anything other than a fairly short period of time. Now, the second section of a cash flow statement is called the investing section. I was getting a little tongue-tied there. So the investing section looks at cash flows that come from the sale and purchase of assets that are of a long-term nature. So not inventory, but what we call capital assets in accounting, pieces of equipment, buildings, cars, trucks, computers, furniture, equipment items that you expect will be used over a long period of time. And so that's an important section, because if the cash flow of the business is negative, and a large chunk of that negativity is coming from an investing section, and you look and you see that it's because the business is buying assets and it's expanding, then that's a one-off activity that's not going to occur in the future. And if they've managed to finance those assets, you'll see a positive cash inflow in the financing section, which is the third section. So that section tracks the cash flows from financing activities, which would be the raising of debt, the repayment of debt, the raising of capital through the issuance of shares, or the reacquisition of shares by paying out shareholders and retiring shares. Those will appear in the financing section as well. And so those three sections each have their own subtotal, and then those subtotals are added to give what the overall cash flow position or change in cash is in the business. So obviously a very healthy business will have positive cash flows overall. The sum of the three sections will be positive, and the sum of the activities in the first section will be positive. The investing and financing sections can be either positive or negative. It doesn't really matter. It just depends on what the business is doing. But if you see a business with negative cash flow overall and negative cash flow from operating activities, that's an indication that the business is in trouble, even if it's profitable. Because if it runs into a position where it cannot borrow any more money, it will eventually go out of business, if that's the case. So that's a more clear understanding of what cash flow is. It's not the same thing as profitability. The two are closely linked, but they are not the same. In order to design your cash flow system to be positive, what you want to try to do is minimize the amount of obligations that the business has, or the number of payments it has to make every month. Or if it has to make, if that cannot be avoided, you want to spread them out as much as possible throughout the month. So, if you have discretion, for instance, I've got, Shopify takes money out of my account every week, and that can't be avoided. I've got a CEBA loan that I got from the government when COVID hit. And that loan comes out on around the 22nd or the 23rd of every month, and it's $800 a month. My mortgage payments on the house that I have to take out money to finance are bi-weekly. So every 2 weeks I have to take some money out of the company to pay those. I've got a car lease that I have to take money out of the company to pay, and that's also a bi-weekly payment. Typically those payments do not fall on the same day. The mortgage comes out on a Monday night. The lease comes out on a Thursday. And having them spaced out like that gives me some means of being able to put some distance between the various payments so that I can manage them around how the auction does each week. I pay my guys every week as well. Well, I pay them bi-weekly, but there's 2 employees, so every week I'm making a wage payment as well. Now, because I'm paying wages, I have to submit source deductions to CRA, and those are due on the 15th of the month. So and that can't be avoided. So what's going to happen with my business is that there are particular weeks where I've gotten log jams of bills. So if I have an auction that closes on, say, the one that closed last night, which is July 8th, it had it typically the money typically comes in before the 15th, so it can handle the source deduction payments that are due, but it doesn't leave an awful lot left over for anything else. And so, right now I'm up to date on my car payment. I just made that last week, but the mortgage payment that I need to make will be due next week. And so I'm going to have to take some money out of the amount that I'm getting for the auction to cover that mortgage. And I may or may not have enough to completely cover the source deductions. So I have to come up with some way, maybe doing a sale this weekend or something, to come up with the extra money to cover that. So that's an example of a small shortfall in cash flow that's arisen because of the dates and the timing of the payments. Anyway, I will do a follow-up video to this to explain a little further, because we're at 21 minutes here, how I've managed to sort that out. Thanks for watching, and hang in there.